The risk to U.S. exceptionalism is a second wave of inflation forces the Fed to hike and or change in Fed leadership and or Treasury yields spike to 6%, which causes the U.S. dollar to overshoot and smacks U.S. earnings per share. Yields cause consumer delinquencies, recession, and liquidation of stocks and crypto. And through all this, the best play is gold to 33.33.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. Today's market rundown, we'll be discussing Michael Hartnett's 33.33 comment on gold over the weekend, Michael Oliver's reiteration that intermediate silver momentum has upticked and we're ready to go, and Joseph Biden's bullish comments on oil. He didn't intend them to be, or maybe he did. We'll find out. So the discussion will be gold and silver with a comment on oil, actually sourced from Zero Hedge. Is kind of important in that respect. All right, let's get started. There's the home page. And you can see various stories, some of which we'll be discussing today. All right, markets. 10-year yields are 476, unchanged bid. The dollar is 109.96, up another 32.33. The S&P 500 is 57.90, down 30 handles. The VIX is 21.21, up 168. Okay, gold is 26.71, down 17 and change. Silver is 29.83, down 57, no, almost 2%. Copper is up 50 basis points at 427. Interesting. WTI is 78.43, up 170. Natural gas is 413, up 11. Bitcoin is 90,726, down 3,700. Palladium is 938, down 3 and change. Platinum is 955, down 7 and change. Gold, silver is up against butting up against 90 again. Soybeans are 1031, up 8. Corn is 465, up 4, and wheat is 545 and 3/4, up 8. Metals are down. Copper is a mystery. Oil is up. Stocks are down. VIX is up. Okay, I can say that metals are down because of the peace breakout. All right, we'll get to this in a second. But the bottom line is, I think the Middle East may be weighing on precious metals right now. I'm not sure yet, but let's get into this. All right, discussion. The first part is Hartnett over the weekend. Hartnett's back from holiday, and his flow show report came out, and in it, he went through his playbook for 2025. We covered it. We did a big walkthrough on it, as we usually do. And he also talked about Greenland, right, as key for Arctic oil and passages and what have you. But there was a paragraph in there, a small paragraph, and I read it and I just kind of glanced over it. And then I read it again. I'm like, wait, this is really bad, aside from the fact that it's bullish for gold. But anyway, so here's the paragraph. The risk to U.S. exceptionalism, meaning the risk to strong dollar and strong stocks at the same time, right, is a second wave of inflation forces the Fed to hike and or the and-ors are me, and or change in Fed leadership, fire Powell, replace him because he's not doing enough or because he's doing too much, and or Treasury yields spike to 6%, which causes the U.S. dollar to overshoot and smacks U.S. earnings per share. Yields cause consumer delinquencies, recession, and liquidation of stocks and crypto. And through all this, the best play is gold to 33.33. All right. There's a lot to unpack there. I read that, like, by the third time I read it, I said, oh shit, this is really bad. So this is when the situation is conflagrated. It's complicated. It's made worse because of the first bad decision. So it's a snowball, right? So, for example, right, the second wave of inflation, which let's assume that we're in it for this conversation. Let's assume that it's much worse than it is and that we're in it, right? That forces Powell to hike. And so Powell hikes. This is really worst case scenario stuff, but he mentioned it. So I'm like, oh crap, this could happen. Forces Powell to hike, right? We're taking things to an extreme here. And Trump doesn't like that. And he wants to change leadership. The point is, even if he doesn't change leadership, you now have a big war between the fiscal and the monetary side. Treasury yields continue to spike because of this uncertainty, among other reasons, to 6%. That will crap stocks out, right? Because the strong dollar, etc. He gives it the whole macro reasons. But the long and short of it is, this is U.S. exceptionalism going into a stagflationary situation. Okay, so he's not using that word yet. He's probably not allowed to. But that's what he's describing. He's describing boom to stagflation. Okay, so he believes we're in boom now, and I'll show you a picture of that. So this is a clock, and this is pretty reliable. If you're a Fed person, you know this clock exists, and the clock is basically you're in a recovery, you're in a boom, you're in stagflation, you're in recession. Now, the arrows on the outside, I've talked about this before. The arrows are the things in the yield curve that predict this. If you're a Fed official or a government official, you know these four things have to happen. You want to speed through the bad one. So it's recovery is great. Boom is great. Stagflation, let's get through that quickly. Recession, let's get through that quickly. So you're constantly trying to short circuit the bad ones, the yellows and the reds. And in doing that, you cause the bigger problems, which is where we are. So he believes that we are here, meaning in the boom area, which is good for commodities. Now we have the full analysis on the 3333 call here. And he doesn't really say much more about gold in the report, but we have plenty more to say about it and what's possible about it. All right, moving on to silver. Michael Oliver's MSA weekend report, weekend 360, he calls it. We're going to give you an excerpt and a paraphrase out of what he said there and a little bit of an explanation. Silver, a nice week up for price and very solid for weekly momentum. For price, it was just a solid weekly rally after repeated attempts at pushing silver into the 29s to get it going on the downside. No luck for the forever silver bears. But for momentum, it ended a three-wave downside process in which the third wave, non-confirming prices, marginal new lows in mid-December, and then it turned up last week through structures. Now, I'm not going to show his charts here because you'd have to explain them as well. You have to be a frequent reader of his stuff, but there are parallels with other structures. So, for example, he uses the word non-confirming. That's an old school term that I also use, non-confirmation, we would call it. And a non-confirmation is when the indicator diverges from the market. The market makes a new low, the indicator does not confirm it, or it diverges. So here's an example of that. It's not perfect, but it's an example. Silver, look at the green lines. Silver made a flat low. You could call it a new low, but it was a flat low. But the RSI, the yellow line at the bottom, did not make a new low. So it will be kind of like the market kept going lower, but it didn't go lower because people wanted to go lower. They were actually running out of gas. So the market was going downhill, but the bottom was in reach, or the momentum lower was in reach. So he has a momentum indicator that probably refines what I just showed you in a more specific way. And then he continues on by saying, weekly momentum had also developed a three-wave decline with the final wave non-confirming the December price lows. Then last week, bang. So I showed you a daily version of that. He's got a weekly version of his momentum as well. So for him, this morning's move notwithstanding, the intermediate momentum has been turned back higher. So I'll try and contextualize today's move with that at the end when we go through the charts. But I don't think we're in jeopardy based on today's move yet. And I'll show you where it will be in jeopardy for me. All right. And for gold, he says, Ditto the initial comments for silver on the prior page. One of the things he does talk about that I think is worth mentioning is that people like to look at the short term begets the intermediate term, begets the long term, you know? And one of the reasons he hasn't been nervous recently is because the long term has repeatedly failed to be unignited. And so he turned his attention to the intermediate term and he got what he needed to see last week. So it's kind of like the macro bias, the big picture bias is steady and solid. It hasn't been negated. And so therefore he looked to the intermediate and short term to uh, lead in this move higher, right? His fundamentals are there if you want to look at it that way. Okay. He has some quotes there on gold as well. Which I actually agree with. The Trump lows were not the lows, but you can read those. News and analysis, we have more excerpts from that on the bottom. I will say this, there were no numbers for silver and gold to break higher to get bullish because they were broken last week. So he was updating us. Most of the work this week, most of the numbers this week were in bonds and equities and miners as well. For me, I paid close attention. I pay close attention to his TLT comment. I think the number is 87 to 87.50. So I'm looking for bonds to bottom soon. I'm not catching knives, but I'm looking for a little momentum off of a bottom, which is kind of his style. All right. Anyway, news and analysis. This is what we did this weekend. Weekly, the big silver stock out of 2025. That's a full, very long report that spends a decent amount of time in walking through what the EFP will be as an effect on silver if it continues. On de-dollarization, that's a chapter, that's an excerpt of a chapter of a book written by Jordan Roy Byrne. That's coming out soon. He asked me to graciously asked me to write a chapter on this topic, and I did, and I'm just putting it out there a little bit early for premium subscribers at Goldfix. Harnett 33.33 gold in second inflation wave. We just touched on that. I would suggest you read that if you want a little bit more color. That's a podcast. Founders comment on market reaction to data on Friday. I gave everyone an on-the-spot reaction to the markets and what they did following the very strong payroll number. Bubbles, the 7 pillars of stupidity. That's a quant fund manager writing about why he thinks we are in some serious bubbles here. Pretty emotional piece for a quant guy, frankly, very polemic oriented. And founders, some reading there for you guys over the weekend that you got oil, Argentina, nat gas, plus a lot more. All right, so we were busy this weekend. Market news. All right, this is Biden decides to enforce. This is kind of infuriating, and I'm going to read slightly edited. That's a combination fact and polemic against Biden's actions on Friday with regards to oil. Now, if you're a fan of Christopher Hitchens, it's a polemic. Zero Hedge, this is Zero Hedge, right? So Tyler Durden, whoever they are, basically is saying, look, this is why Biden sucks. Here's the facts. And then it ends with, and I told you Biden sucked. He sucks. And they're right. So let me read some of this and tell you specifically why I agree with it. And, it's something I would have written if I was in that mood. Anyway, so here we go. Last Friday, with less than 2 weeks to go until Biden exits, when we got the shocking news that the U.S. Treasury would enforce sanctions. The key word is enforce sanctions against Russian oil giants. I can't pronounce it, and Gazprom, while also dramatically expanding a highly effective program of targeting individual oil tankers, expanding the list to some 270 total tankers sanctioned for carrying Russian oil, listing traders organizing hundreds of illicit shipments, naming pivotal insurance companies, and telling 2 U.S. oil service providers to exit. I'm going to walk you through quickly what this is. When Biden levied sanctions against Russian oil. He didn't enforce them. Now, how do you enforce them? You enforce them by naming names, this tanker, this company, that insurance company. He kind of filed the sanction and didn't fill in the blanks. So, in effect, what he's doing is it's a sanction, right? And he's going to turn the other way on certain tankers because he didn't want to piss off China, right? Let's make sure they get their oil. Let's not stop Iran from shipping. Let's look the other way. What did he do? He appeased American warmongers. He looked tough with the Ukraine war, and he did dick to enforce it. And he did dick to enforce it because he didn't want domestic inflation from higher prices. Okay. He was, in effect, in another derivative of this, he's working with Powell in that respect, right? Powell didn't have to raise rates as much as he would have if this was enforced. Now, the reason I mention insurance companies is that tankers have flags. So I'm flying a flag of this or that, right? And so the tanker gets named and the tanker can no longer carry oil or it'll be stopped militarily, sanctions, or whoever's taking in the oil, if they receive it, they'll get hit with sanctions. So what these tankers do is they start putting it in smaller ships. It's not piracy, but it works like this. One of the effective ways to enforce sanctions for oil is you go to the insurance company. These tankers have to be insured. You go to the insurance company and say, let me see your manifest of who you're insuring. If you insure this guy, I'm going to shut you down. Like, you just go to the source of the insurance. And by the way, that's very bad for Europe and it's very good for India. Another conversation. But so the insurance companies get hit. The tankers say, all right, well, let's get smaller tankers. They put their stuff in smaller tankers, change flags, and go with Indian insurance companies that are willing. It's like a gypsy cab, like an Uber versus a car service. And you start doing that, and you get around it. Now, again, to Zero Hedge's point, targeting individual oil tankers, expanding the list to some 270 total tankers sanctioned for carrying. So now they're like, all right, let's put the names of the tankers that are actually carrying the oil. So this hurts Europe, this hurts India, this hurts China. Okay, it raises the price of their oil that they have to get. And of course, it raises the price of our oil. So here we are, Biden going out. I'm getting into a little bit of my own polemic here. Biden is going out and saying, he's giving the finger to Trump. He's saying, those sanctions, I'm going to do them now because there's no chance of me getting reelected or Harris or whatever other stand-in robot they had, right? We're not so worried about inflation anymore, right? Because this makes gasoline. This is in the wintertime. This hurts Europe. Diesel prices go up. Okay, diesel prices go up, heating oil prices go up, gas oil prices go up. It's bad. If it shouldn't be bad for winter, but it will be bad for spring because the cracks are going to have to turn over and gas prices go up. It's going to be bad for the U.S. So Trump walks in with higher oil prices, right? He walks in with sanctions that are being used. He looks bad no matter what he does in this situation. Anyway, so enough with my polemic. Let me go back to what Zero Hedge says. So in short, an unprecedented crackdown on Russian oil exports, that's what this is, which should have taken place the day after the Ukraine war started. That's right, but didn't because Biden knew it would send oil prices surging. And that's a Zero Hedge story, and it's one of those Zero Hedge stories, like, it's basically facts, and this is why Biden sucks. And they're right. So there's the link to that. We'd encourage you to read it. I'll give you an idea what I'm talking about here. See this chart? This is a Bloomberg chart. The brown, dark brown, whatever you want to call it, those are the U.S. tankers that are sanctioned. We have a list of let's say 271 tankers that can be sanctioned. We only sanctioned 50 through 22 to 20, 22 and 23. We nothing, right? 24, we sanctioned a little bit. 24, June, July, September, October, November, December. And now here we are, January 10th. And of the 271 tankers in the world, I'm making that number up, let's sanction 270. So all of a sudden, he's making good on his promise, which, these people suck. All of them suck. They can't be honest. All right. Here's another. Let me just throw this in there. I had this as a caption. Biden's surprise move could reduce what the International Energy Agency predicts will be a supply surplus of almost 1 million barrels a day this year to zero. Okay, so we were going to have 1 million barrels of surplus, which you need surplus to handle any unexpected problems, right? But now you have no surplus. So now basically you're breaking your own supply chain of oil. That's what we're doing, right? We're saying, okay, you have no surplus. You have nothing in stock. You have a stock out of oil if there's a problem because it's just not easy there, which makes people that know this say, all right, let me buy my oil now before it gets worse. All right, there you go. That's it. It's a really, really good piece. All right, geopolitics, Gaza breakthrough, Ukraine pain. You can read all that. But I think there was a meaningful breakthrough, and that might be one of the reasons, or the main reason, that metals are lower. Why is silver lower than gold? Because they sell silver when they don't want to sell gold. If they're long gold, they don't want to sell it. They sell silver against it. Why is copper up? Well, copper is very, silver is like the most hated metal today, right? So it's like, all right, I guess they'll just sell more silver and I'll cover my copper. The point is everything doesn't have to happen simultaneously, right? So over the last week or two, silver has withstood some selling and been strong. Copper has not withstood some selling, and gold has shrugged off any selling. And it's all about WTI now. So let's take a look at the next page and we'll get out of here. All right. So PPI first, then CPI this week, I believe, and also retail sales. So pretty big week for data. And then we have a little bit bigger version of the excerpt from Michael Oliver. So here's WTI. I believe, patting myself on the back, on Friday last week, on Friday morning, I said with the market in here somewhere, I said, oil is safe to buy at any price as long as it's above this structure here. So, all right, am I long oil? Yeah, I have some exposure, but nothing for me to retire on. Anyway, so there you have it. Gold. All right, so there's a gold daily with the moving averages, which have been very informative. I know, how about this? I know that China was a buyer between 25.80 and 26.20. I believe that they're still there. I know that people that are front-running China are buying this 100-day moving average. The 50-day, thankfully, doesn't mean anything. However, if it crosses the 100-day, you might see some bears come in. I think, looking at silver now, I think that this is, again, silver is, again, flirting with the 200-day moving average. If silver cracks the 200-day moving average and gold does not crack the 100-day moving average, think of it this way. In 3 months, everyone will be short silver and no one will be short gold. And we could have a 2022 situation that a big buyer comes into physical, let's say India, and the funds are selling it. And, April, June, that area, silver will have another leg higher like it did from September of 22 through June of 24. That's it. That's my take on it. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. I sure hope you enjoyed the show and that it was a great start to your day.
So thanks for being here. And before we wrap up, would also like to thank Fortuna Mining, who kindly brought us today's show. And 2024, really a great year for Fortuna because they had a lot of progress now that their mine at Seguela has been fully online. In the fourth quarter, they announced that their share repurchase program had repurchased 6.4 million shares. They also had drill results where they extended the mineralization at their Kingfisher deposit at that Seguela mine. They also had a mineral reserve and resource update that they put out on December 10th. And of course, this was following record attributable earnings of $50.5 million in the third quarter, which leaves them as a company that has new mines coming online and an active exploration budget, as well as the elevated gold price, still well over $2,600. So a great 2024 for Fortuna and a lot to look forward to in 2025, especially as they have costs coming down as their leach pad expansion program at their Lindero mine is now nearing completion. So definitely a company that you will want to be aware of this year. And congratulations to Fortuna on their success. And thank you for watching, and we will see you again tomorrow.
Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.